this can go on so much longer than a lot of people can imagine. It's the bicycle theory, in that as long as you keep riding the bike, things can go on. And the Fed can print so much money in the U.S., so the U.S. can keep printing money for so much longer. It's much longer than I think a lot of people's investment time horizons can be.
This is Dunnigan Kaiser, founder of Liberty in Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us kaiser@milesfranklin.com.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And with us today is Michael Lee, the founder of Michael Lee Strategies. He manages assets for high net worth individuals. Michael, thank you so much for joining us today.
Thanks for having me.
Regarding the topics today, I really wanted to dive into something that's been on a lot of people's minds recently as we're emerging out of this COVID-19 pandemic and the Federal Reserve is printing like never before, right? And there's a lot of stimulus being pushed into the economy, and we're starting to see a little bit of inflation. A lot of people are thinking that this inflation will pick up. In your view, and we'd like to get everyone's views on this, it's really interesting how you see it. Correct me if I'm wrong, but you don't see inflation as a very big threat right now.
No, the Federal Reserve, with the amount of liquidity they're providing and the actions they've taken in response to COVID, has created quite a bit of controversy. And I certainly don't agree with everything the Federal Reserve says or does, but what I can say is I do agree and believe that a lot of the inflation we're seeing at the moment is what they call transitory. And now that's a fancy word for saying temporary. And people say, well, what about lumber prices? And what about copper? And what about this? And what about that? Well, there's a lot of things you need to understand. First is the economy has come back much stronger than anyone would have imagined. So, not to go too far into the stock market, but analyst estimates for the first quarter earnings on December 31st were 15.9%. Then on December 31st, they were 23%. I'm sorry, on March 31st, they were 24%. And right now we're tracking at about 46. So to put that in perspective, Wall Street sell-side analysts are the most bullish people that have ever existed in the history of time. Their analyst estimates are always too high for everything, year in and year out, regardless of the type of market we're in. And I don't bring that up to pick on the sell-side analysts, even though it's easy. It's just to point out a picture that no one really thought we would come back this hard, this fast from this pandemic from an economic standpoint, particularly in a production and manufacturing standpoint. So as a result, miners, commodity manufacturers, and various points along the supply chain were simply not geared up for this, as well as the fact that a lot of their systems, shipping routes, ports, all these things are still, all these different points along the supply chain that we are dealing with are still broken to a degree from this pandemic. So it's my thought that a lot of these things, a lot of these problems will be solved over the next year. We will have a supply glut at some point next year when demand slows relative year over year. I do think the economy, although it's doing pretty well, will not continue at this furious of a pace. And so when you have this supply glut and all the logistical problems in the supply chain are solved, a lot of these price surges that we're seeing will work in the other direction. Does that make sense?
I think it does. So essentially what you're saying is maybe the economy is getting a little bit of ahead of itself right now, and we're going to slow down coming maybe next year.
Yeah, well, also slow down relative to expectations. I think I think this snapback the V-shaped recovery that we've seen from an overall standpoint. Obviously, they call it the K-shaped recovery because the people at the bottom are taking it on the chin. It's my argument that these people don't move the economy from a macro standpoint. So a lot of the purchasing managers, the various points along the supply chain were not forecasting or predicting the growth that we've had, combined with the logistical challenges caused by COVID. And you're seeing some short-term inflation spikes that I believe will be temporary. I think although the key driver of why we're not going to have a lot of inflation in our economy is based on the banking system.
And do you measure, when you speak of inflation, do you mean the CPI? Because a lot of people have pointed out, it seems like if you go by how the average person experiences inflation, some people argue that inflation right now is actually a lot higher than the CPI says it is.
Yeah. So look, from where the Fed sits, and the CPI measurements they use, we'll see some high prints this year, and we'll see some low prints next year. Are things going to get higher for people? Are things going to get harder for people on a fixed budget? Absolutely, right? And so I think most people look at quantitative easing, and they say, this is going to cause hyperinflation akin to, as well as the deficit spending akin to a Venezuela and a Zimbabwe. And it just doesn't work that way. It does punish savers. It does punish those at the bottom. It acts as a wealth transfer tool to the ultra wealthy, i.e. the stock market, maybe not commercial real estate in this crisis just because of the structural changes we're going through, but certainly residential real estate.
So with respect to investing, how are you looking at this environment?
Right now, primarily equity. So I think I always own, the long bond as the number one hedge against shocks in the system. So in 2008, the 30-year Treasury was up 35%, and the S&P 500 was down 36%. And same in this last spike, I believe peak to trough, the S&P was down 35%, and that same long bond was up 30%. So I always own that as a portion of portfolio, but I'm in the process of reducing that across all sectors because I think that the 30 years trading in the 220 to 240 range, I think you could see that go up to 265 to 285, which is a bit of a shock, but we're not going to see 5 or 6% 30-year interest rates, I don't think, ever again in my lifetime. So with the remaining portion of my client's portfolio, I look at things I'm balanced between technology, the high flyers, as well, and the cyclicals. So it looks as though the banking sector, the financial sector, is very resilient. Consumer staples, basics, and energy, kind of your recovery trade combined with that with technology, even though technology's run so far so fast.
And you've spoken before about kind of how the stock market will experience a lost decade once in a while. And that was, 1999 to 2011 or so, just kind of the stock market was flat. And then after that, we've seen this huge rally and still is rallying today. So how long do you expect this rally to continue, this bullish stock market trend, before we see another lost decade or a crash?
See, that's a great question. It's hard to say. I would imagine that with the quantitative easing that we have right now, okay, that hyperinflates financial assets. So essentially what we're doing at the moment is pulling equity returns forward. So I don't know if that lost decade is going to start in 2 years or 5 years, but I do think it's years away. And we are in a new business cycle, if you will, now. And that business cycle is not going to end until we have some sort of debt bubble. All right. When is that debt bubble going to come? And will the Federal Reserve ever let that happen? Or are we going down a road of Japan where you have tons of zombie companies floating around that have so much debt, but interest rates are so low that all they can do is service debt or issue new debt to pay the interest on the old debt instead of these companies going bankrupt. So, this is going to come to a head at some point. It can take so much longer than many people imagine. And it's not going to probably happen at any point in the next 18 to 36 months. And so if you're an investor and you need a certain rate of return going forward and interest rates are never going to get much higher, you need to own stocks right now. You can do that through different sectors of the S&P 500 with the sector ETFs, which is primarily what I invest in, which are great tools to manage risk and harness all the return.
And when it comes to, you mentioned this debt bubble, right? And if we look at the U.S. compared to other countries, how bad is the situation for the U.S. right now?
If you look at U.S. debt, so if we look at government debt relative to household assets, so Japan is at a 1-to-1 right now, where their debt is 3x their GDP, but it's about the equivalent of their household assets, right? Our household assets are 125, 130 billion, and our national debt is 29 trillion, 30 trillion. Sorry, we're dealing in the trillions in the U.S. So we got a 4x on our debt before we get to the ratios that Japan is, right? And Japan, the economy muddles along, but there's been no Armageddon over there. And so I think a lot of the doomsdayers look out there and say that this debt bubble for the country, and we can't keep printing money forever. You're right. We can't keep printing money forever. This can go on so much longer than a lot of people can imagine. It's the bicycle theory, in that as long as you keep riding the bike, things can go on. And the Fed can print so much money in the U.S., so the U.S. can keep printing money for so much longer. It's much longer than I think a lot of people's investment time horizons can be. And so if we're running trillion-dollar deficits, but we have a $24 trillion economy that's growing at 3% per year, that's really, the growth, the deficit above and beyond the growth of the economy, you're only adding a few $100 billion to our national debt, right? If we have $4 and $5 trillion deficits, as far as the eye can see, yeah, that could be a huge problem. But if we're a country running $1 trillion deficit, but our economy is growing at $700 or $800 billion a year, is that really the end of the world? Are we going to hit this? Is the rubber going to hit the road the same way it is in Japan, where your national debt is 3x GDP and a 1-to-1 with household assets? Right now, household assets exceed our national debt by almost 4-to-1. So we have a long way to go before we can get there. And that's not to say it's good. What I'd say the real problem with it is the larger government gets, okay, the less the private sector can grow, and you permanently inhibit the ability to grow that long forever. It's like a business adding overhead that it can never, ever, ever get rid of. And so the less efficient we become, the harder it is for small businesses and for the aspiring wealthy. Okay, this printing money insulates what you would call the elite and the investor class above everyone else. And maybe that's part of the reason why they're printing so much money. I would argue that the $80 billion in treasuries and $40 billion in mortgages the Fed is buying right now is, they probably should be buying some, but that's, that might be 2 or 3x what they have to. Does that make sense?
Yeah, and when people are looking at these kinds of things that are happening, the ballooning debt, and even though, Japan, as you mentioned, has it a lot worse compared to how many assets the population has, right? The total value of the assets. They're still seeing that, and they're seeing how much money the Federal Reserve is printing, and they're turning their eyes to gold, and they're also seeing, the COVID crisis and that gold as a safe haven. What is your perspective on gold right now?
So if you want to invest in gold, okay, I would say you need to do that in physical gold. So gold is a portion of my assets. It's a very small portion. I'd say it's somewhere around 1 to 2%, but it's all physical, right? So anybody that wants to invest in gold, I would do so in the physical form, right? But for a client's portfolio, the way that I view gold is as a trading vehicle. So I am looking to buy low and sell high in temporary price displacements. It's not something I'm looking to sit on for an elongated period of time. And you would have thought that gold would be much higher right now. I would have thought when Joe Biden won the election and when the other 2 seats went to Democrats in in Georgia, that you would have seen a gold move like we saw, circa 2009 to 2011, where it just absolutely broke out and hit all-time new highs. We just haven't seen that now, and I think it's the longer-term gold investors must have the market movers must have an inflation view similar to my own, and that when the money system and the velocity of money is as slow as it is now, it's hard for you to have this runaway inflation to justify having a large position in gold as a portion of your investment portfolio.
Now, with respect to that, kind of what is causing the move in gold? I mean, we have seen, we're not at all-time highs right now, but really it has been an extraordinary move since the beginning, kind of right after that crash after COVID. It has been an extraordinary move that we've seen in gold. So what do you think has really been pushing gold and also silver higher?
For whatever reason, the silver historical relationship to gold seems permanently broken, right? Which is unfortunate for silver investors and for people that try to trade it like I have for some of my clients. Whenever you're coming out of a crisis like this, you're going to see a reflation of all these assets, right? And so you have seen a significant move of gold. But if you look at gold from, say, the end of 2011 to now, and you look at the S&P 500 or the NASDAQ or the tech sector to now, what has been a better investment? So I think there's a base and there's an investor base in gold, but the fact of the matter is it's never going to become, well, I don't want to say never, but I don't see it happening in the next decade or two, which is the way that I look at investments is going to become a currency replacement. Okay, if something does happen and it does become a currency replacement, that GLD that you own in your Schwab account or Merrill Lynch account or wherever you have it is not going to get the job done. So I think you have a reflation trade in everything, but given the amount of money that we printed, I would have expected to see a much more substantial move if gold is a store of value, a medium of exchange, the way that many view it.
So I guess what you're saying is, on the one hand, we have seen a rise in gold, but if it was an inflation hedge, as a lot of people say it is, you would be expecting a greater move. Is that what you're saying?
Yes, or if it still is that inflation hedge, that we're not going to have this runaway inflation the way many people believe, because inflation in a developed economy from money printing does not happen the same way it does in, say, Venezuela or Zimbabwe. You're two extreme examples on the other side. Because if you look at the U.S. dollar, we will not be the reserve currency forever, but something new needs to come along. It is not going to be China. You look at how levered up we are in our banking system, our national debt. China's domestic currency is essentially worthless, right? If they're 15% of world GDP, why is less than 1% of their international SWIFT transactions take place in Chinese local currency? It's because their money is monopoly money. On a normal year, we run our fiscal deficits are somewhere between 3 and 5% of GDP. China, in the best of days, is running a 10% deficit. Their banks are more levered than any other banking system in the history of the world. It's rumored that half the loans that these banks have are bad loans that just keep getting rolled over and rolled over. Their entire financial system is a house of cards, which is why the Chinese government does business with the rest of the world in the US dollar. Okay, then you look at Europe. Okay, Europe, the problems there far exceed the problems here. They can never grow like us. They have so many structural challenges that the U.S. has. So if it's not going to be the EU and it's not going to be China, and we've already discussed what kind of situation Japan is in, what currency is going to overtake the U.S. dollar as a reserve currency for the world? And
you're saying none of them, at least for a while.
None of those ones. That doesn't mean, in 20 years, wars won't be fought, regimes won't be changed, and then at some point the U.S. dollar will not be the reserve currency. I just don't think I'll be alive then.
Coming full circle here, kind of with respect to inflation, that seems to be your view, is that these things can take a long time to play out. And even though it seems like the debt situation is unsustainable, the Fed is creating so much money, it takes a lot longer for that to actually have the impact a lot of people think it will.
Yes. So look, if we have $7 trillion deficits every year for the next decade, you will see household assets flatline, and you will see the U.S. debt go from 30 trillion to 70 or 80 trillion, right? Then but I just don't see that happening. I see the U.S. budget deficit somewhere between $1 trillion and $1.25 trillion. And if the economy is growing at $700 or $800 billion a year, that's sustainable for a very, very long time. It's not good. And in reality, at some point, you have to figure out a way where your economic growth exceeds your budget deficit. And this Fed balance sheet needs to find a way to run off, okay, which I don't know when or if that'll happen. Otherwise, we'll never, ever see 3% GDP growth again. And so as the government gets larger and debt gets larger, our GDP growth is going to get slower and slower and slower. So as the debt creeps up and the GDP growth goes down, at some point this will come to a head. And if we get these MMT zealots in charge of fiscal policy, yes, this will be a problem. Okay, this is bad. There's a lot more room to go, and I just don't see it happening in the next few years. Meanwhile, what this money printing does is it pulls equity returns forward. So we may not end up with the lost decade, say in 2030 to 2050, the markets may not go anywhere, and you may get 2 or 3 decades worth of return in the next 5 or 6 years because of all of this money printing. And so people that are boycotting the stock market, waiting for it to go down, will go down 8 or 9 years from now, and you've missed all this different return. You end up buying it here, and then it goes nowhere for a long time, if that makes sense.
With respect to your view in gold, it's you hold the physical gold for kind of that worst case scenario, correct?
Yeah, absolutely. And look, and if you think I'm wrong and you disagree, maybe you want to have 10 or 15% of your liquid assets in there. If you're okay with having gold being between $1,800 an ounce, $2,200 an ounce for the next decade, and it doesn't really go anywhere, but in 15 years from now it doubles overnight. If that's term profile you're okay with to sleep at night, I would definitely own that in the physical form. I don't mean to be silly, but I have a friend that's a government agent, and he's prepared for a zombie apocalypse, right? Like, he's very high level classified documents he's seen, but he's fully prepared, and it may not be a zombie apocalypse. What if this coronavirus was a much worse pandemic that didn't kill 500,000 people, killed 50 million people, right? I tell you, at that point, you'll be thankful that you have some physical gold. And if I'm wrong about inflation, then you will have made a very nice return on that investment.
I think that's a really good point, like kind of holding physical gold as insurance against a worst case scenario. But Michael Lee, thank you so much for your time today and sharing your insights. Before we let you go, did you want to share with the viewers any last thoughts you'd like to leave with our viewers and where they can find you online?
Yeah, so look, I'd say if you look at the history of markets, we trade in cycles. We are in a new business cycle right now. We had a very brief recession. I think as a result, this business cycle is going to be a brief business cycle, but during it, stock markets basically go up. You have intermediate corrections, but the equity markets go up substantially. So if you miss that, you typically have 5 to 7 good years followed by 2 to 3 bad years. So if you miss half the good years, that's completely wiped out, and you make no money over a decade. So I'd say you need to have an allocation to equities right now based on your risk tolerance and your comfort level. And then if you have any more additional questions for me, my website is michaelleestrategy.com. All I do all day is help individuals answer these questions and how these investments play out into practical applications to create cash flows and various things in their retirement. I'm also on Twitter at Mike Lee Strategy.
Fantastic. And if our viewers would like to hear more of these interviews and keep up to date with all the ones we're producing, they can go to libertyandfinance.com. In the left-hand corner there, they can sign up for the free newsletter. Once again, Michael Lee, thank you so much for your time today, and God bless.
Thank you very much.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us kaiser@milesfranklin.com.